Every year, millions of Americans celebrate their 65th birthday, believing they have finally crossed the finish line. Medicare kicks in. Social Security is either already running or sitting right at the door. The house is paid off. The kids are grown. The hardest years, the working years, are behind them. And then, quietly, without a single letter from the IRS, without a phone call from their financial advisor, without a single warning in the mainstream financial press, they start losing money. Not from bad investments, not from scams, not from market crashes, from tax benefits they never knew were slipping away, benefits that, combined, can cost the average American retiree anywhere from $2,000 to over $10,000 a year in unnecessary taxes. That is not a number we invented. That is a pattern documented in IRS data, retirement planning research, and the lived financial reality of retirees across this country. Today, we are going to lay it all out, clearly, step by step, so that you are not among the millions of retirees who hand the government more money than the law actually requires. These are the 4 tax benefits most retirees quietly lose at 65. And more importantly, here is exactly what you can do about it. Stay with us. This information is worth thousands of dollars. Why age 65 changes everything about your tax situation. To understand why 65 is such a critical number, we first need to understand what actually changes when you hit that birthday. In the United States, age 65 is not just a social milestone. It is a legal and financial trigger point built directly into the tax code, the healthcare system, and the Social Security framework. At 65, you become eligible for Medicare, the federal health insurance program. That sounds like a benefit, and in many ways it is. But it also introduces a set of premium structures and income-based surcharges that most retirees are completely unprepared for. At 65, if you were born before 1960, you are either already drawing Social Security or you are being pressured by family and financial media to start claiming. And the moment Social Security income enters the picture, it can trigger a series of tax consequences that many people never see coming. At 65, the rules around retirement account withdrawals, your 401k, your IRA, your pension, also begin to shift in ways that affect how much you owe in taxes each year. And at 65, several income-based tax credits that were designed to help moderate-income Americans can phase out, shrink, or disappear entirely based on how your retirement income is structured. Here is the core problem. The U.S. tax code was not designed to make this easy to understand. It was built in layers over decades, with different rules for different income types, different thresholds for different benefits, and almost no centralized explanation that connects all of it together. Most retirees, and frankly many financial advisors, treat age 65 as though the tax rules stay the same. They do not. And the difference between understanding these rules and ignoring them can be the difference between a comfortable retirement and a financially stressful one. Let us start with benefit number 1. Tax benefit number 1, the retirement savings contribution credit and the IRA deduction trap. Retirement account deductions and credits. Here is a benefit that millions of working Americans use every year without even realizing it has an expiration date tied to retirement income. It is called the Retirement Savings Contributions Credit, sometimes called the Saver's Credit. It is a federal tax credit, not a deduction, an actual credit, that reduces your tax bill dollar for dollar if you contribute to a qualifying retirement account and your income falls within a certain range. For the 2024 and 2025 tax years, this credit is available to individuals earning below roughly $38,250 and married couples earning below $76,500, depending on the year. It can reduce your tax liability by up to 50% of your contributions, with a maximum credit of $1,000 for individuals and $2,000 for couples. Now, here is where retirees run into a wall. Once you start pulling money out of a retirement account, which most people begin doing at 65 or shortly after, your taxable income rises. Pension payments, IRA withdrawals, 401k distributions, they all count as ordinary income. And the moment that income crosses the threshold for the saver's credit, the credit disappears entirely. It does not phase out gradually. For many retirees, it simply vanishes. But there is a second trap hiding here, and this one catches even financially literate retirees. Many people believe that once they retire, they can no longer contribute to an IRA and get a tax deduction. That used to be true. But the Secure 2.0 Act removed the age limit on traditional IRA contributions. If you have earned income from part-time work, consulting, freelance projects, you can still contribute to a traditional IRA, and depending on your income and whether you have a workplace plan, you may still qualify for a deduction. The trap is this: thousands of retirees stop contributing and stop claiming deductions they are still legally entitled to, simply because they assume the rules changed when they turn 65. Consider the case of a 66-year-old retired teacher who picks up tutoring work on the side. She earns $8,000 a year from tutoring. She does not contribute to an IRA because she retired. She does not claim the saver's credit because she thinks it no longer applies. She misses out on a legitimate deduction and a potential credit year after year simply because no one told her the rules had changed. That is real money. Do not leave it on the table. The earned income tax credit cliff. Most retirees never see coming. Earned income credit, the invisible cliff. The Earned Income Tax Credit, or EITC, is one of the most powerful anti-poverty tax tools in the federal system. For lower and moderate income working Americans, it can be worth anywhere from a few hundred to over $7,000 per year. And as of the American Rescue Plan Act of 2021, adults aged 25 through 64 with no qualifying children became eligible for an expanded version of this credit. That expansion was significant, and it helped millions of near retirees. But when you turn 65, that expanded eligibility ends for childless adults. If you have no qualifying dependent children and you cross that age threshold, the EITC rules that applied to you at 64 no longer apply at 65. Now, to be clear, retirees with qualifying children or grandchildren they are raising may still qualify, and the income limits must still be met. But the structural eligibility for the childless adult expansion cuts off at the birthday. Here is the insidious part. Many retirees never claimed the EITC before 65 because they did not know they were eligible during their final working years. And by the time they realize what they missed, it is too late to go back. Take the example of a 63-year-old warehouse worker who retired early due to physical limitations. He earns $18,000 a year from part-time work and Social Security combined. He qualifies for the EITC. He doesn't claim it because he has no children and always assumed the credit wasn't for him. He leaves approximately $1,500 a year on the table for 2 consecutive tax years, and then loses access entirely when he turns 65. The lesson here is not just about what you lose at 65. It is about making sure you claim everything you are entitled to while you still can, and understanding the exact moment the rules change. Tax benefit number 3, how Social Security benefits quietly become taxable. This is arguably the most misunderstood element of U.S. retirement taxation, and it causes more financial pain for more retirees than almost anything else. The widespread belief, repeated in casual conversation, on social media, in family dinners across America, is that Social Security benefits are not taxed. That belief is wrong, it is outdated, and it is costing retirees real money. Here is the actual rule. If your combined income, which the IRS defines as your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefit, exceeds certain thresholds, a portion of your Social Security becomes taxable. For individuals, if combined income exceeds $25,000, up to 50% of your Social Security benefit may be taxable. If it exceeds $34,000, up to 85% becomes taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. And here is the critical detail that no one tells you. These thresholds have not been adjusted for inflation since 1983. They are frozen, fixed, locked in place, which means that every year, as Social Security payments increase through cost of living adjustments, more and more retirees cross these thresholds, often without realizing it. Consider a retired couple in Ohio. Between them, they receive $36,000 a year in Social Security and $20,000 from a pension. Their combined income calculation pushes them well past the $44,000 threshold. Suddenly, up to 85% of their Social Security benefit is subject to federal income tax, potentially adding thousands of dollars to their tax liability. They had no idea. Their tax preparer told them at the end of the year. Now here is the important nuance. The tax is not on 100% of the benefit. Maximum taxability is capped at 85%, and the actual tax owed depends on your overall marginal rate. But for millions of retirees sitting just above these thresholds, the impact is real, meaningful, and entirely predictable, if you know the rules in advance. The strategies to manage this, and there are effective legal ones, are coming up shortly. But first, let us discuss the fourth and final benefit, tax benefit number 4, Medicare premiums and the IRMA surcharge. Most retirees don't know exists. Medicare IRMA, the hidden tax on success. When Americans think about Medicare, they tend to think of it as a fixed cost program. You pay the standard premium, roughly $174.70 per month in 2024 for Part B, and that is that. But what most retirees do not realize until they receive a letter from the Social Security Administration, sometimes months after a financially significant year, is that Medicare has a built-in income-related premium surcharge called IRMA, the Income-Related Monthly Adjustment Amount. IRMA is not a penalty. It is not a mistake. It is a deliberate feature of the Medicare Modernization Act. And depending on your income level, it can add hundreds of dollars per month to your Medicare premiums for both Part B, medical coverage, and Part D, prescription drug coverage. Here is how the tiers work for 2024. Individuals with modified adjusted gross income, MAGI, above $103,000, or married couples above $206,000, begin paying IRMA surcharges. At higher income levels, those surcharges escalate. At the highest income bracket, a retiree can be paying more than $500 per month for Medicare Part B alone, nearly 3 times the standard premium. But here is the catch that blindsides thousands of retirees every year. IRMA is calculated based on your income 2 years prior. So a retiree who sells a rental property, converts a large IRA to a Roth, or takes a major one-time distribution at age 65, may find themselves hit with IRMA surcharges 2 years later, even if their income has since normalized. Take a 66-year-old retiree in Florida who, at age 64, cashed out a significant portion of her 401k to pay off her mortgage. It seemed like a smart move in isolation, but that withdrawal pushed her income into an IRMA bracket, and 2 years later, her Medicare premiums jumped by over $200 a month. That is $2,400 a year, for a decision she made before she even enrolled in Medicare. This is not a rare story. It happens across the country, quietly, to retirees who were never warned. Why millions of retirees misunderstand these rules. We need to take a moment and talk about why this knowledge gap exists, because it is not an accident and it is not a personal failure on the part of retirees. The U.S. tax code is genuinely complex. Rules change constantly. The Secure Act in 2019, the Secure 2.0 Act in 2022, the American Rescue Plan in 2021. Each update shifted thresholds, changed eligibility windows, and altered the strategy landscape for retirees. Very few people, even professionals, keep up with all of it. Meanwhile, online financial content is awash with outdated information. Articles written in 2015 still rank on the first page of Google. Social media posts citing obsolete rules circulate endlessly. Well-meaning family members pass down tax myths like heirlooms. Social Security is tax-free. You can't contribute to an IRA after 70. Medicare is the same price for everyone. These statements used to have some truth in them. Today, they are dangerously incomplete. And the financial advisory industry has its own gaps. Many retirees see a tax preparer once a year, often during peak filing season, when there is no time for deep strategic planning. The return gets filed, the refund, or the bill, arrives, and the underlying tax strategy for the coming year receives little to no attention. The result is a population of retirees who are doing everything right by the social rules of retirement, but who are systematically losing thousands of dollars every year to tax rules they were never taught. How retirees can legally protect their savings and reduce taxes now. And this is the part that matters most. Let us talk about what you can actually do. Because these are not unfixable problems. They are predictable, plannable, and with the right strategies, they are manageable. Strategy 1. Roth conversion laddering. If you have a significant traditional IRA or 401k balance, one of the most powerful tools available to you is converting portions of that account to a Roth IRA over several years, ideally in the years between retirement and when you are required to take minimum distributions. Roth withdrawals do not count toward your combined income calculation for Social Security taxability. They do not trigger IRMA surcharges, and they are not taxed in retirement. The trade-off is paying tax at conversion, but if you do it strategically in lower income years at lower marginal rates, the long-term benefit is substantial. Strategy 2. Managing combined income to stay below Social Security thresholds. If your combined income is close to the $25,000 or $32,000 threshold where Social Security becomes taxable, there are real ways to manage it. Pulling from Roth accounts instead of traditional accounts, carefully timing IRA distributions, reducing or deferring investment income where possible. A qualified financial planner can map out exactly where you stand, and sometimes modest adjustments can keep you below a threshold that saves thousands. Strategy 3. IRMA appeals and income reduction events. If you experience a significant drop in income, retirement itself, the death of a spouse, divorce, or loss of income-producing property, you can formally appeal your IRMA surcharge by filing Form SSA 44 with the Social Security Administration. IRMA is recalculated annually, and you are not necessarily locked into a 2-year-old income figure forever. Many retirees do not know this appeal process exists. Use it if you qualify. Strategy 4. Qualified Charitable Distributions, QCDs. If you are 70 and a half or older and you are charitably inclined, you can make a qualified charitable distribution, a direct transfer from your IRA to a qualifying charity, of up to $105,000 per year in 2024. This distribution satisfies your required minimum distribution obligation, but it does not count as taxable income. That means it does not inflate your magi, it does not push your Social Security into higher taxability territory, and it does not trigger IRMA surcharges. For retirees who give to charity anyway, this is one of the most tax-efficient moves available. Strategy 5. Claim every credit you still qualify for. Before you turn 65, make sure you are claiming the Savers Credit if you are still contributing to a retirement account. Make sure you are evaluating EITC eligibility during your final working years. After 65, revisit your eligibility annually. Circumstances change, income changes, and credits you did not qualify for last year may apply this year. The 4 tax benefits plus 5 strategies, quick reference. Let us bring this together. Tax benefit number 1. The Retirement Savings Contribution Credit and IRA deductibility. These do not automatically disappear at 65, but rising retirement income can phase them out. Know your thresholds. If you still have earned income, keep contributing if it makes sense. Tax benefit number 2. The Earned Income Tax Credit expansion for childless adults. It ends at 65. If you are in your early 60s, low to moderate income, and not claiming this credit, you may be leaving real money on the table right now. Tax benefit number 3, Social Security taxability. Up to 85% of your benefit can be taxed. The thresholds have not moved in 40 years. Plan your withdrawals and income mix to stay below those lines wherever possible. Tax benefit number 4, Medicare IRMA surcharges. A single high-income year can cost you hundreds of dollars per month in premiums 2 years later. Major financial events, Roth conversions, property sales, large IRA withdrawals, need to be evaluated for their IRMA impact before you act. And the strategies, Roth conversions in low-income years, managing combined income near Social Security thresholds, appealing IRMA when income drops, using qualified charitable distributions, and claiming every credit available during your final pre-65 working years. None of this requires a law degree. It requires awareness and the willingness to plan 1 year ahead instead of reacting after the fact. Retirement is supposed to be the reward. Decades of work, of saving, of delayed gratification. It should pay off. And it does, for the people who understand the system they are living inside. The tax code does not punish retirees intentionally. It was not designed to be fair or intuitive. It was built over decades of political compromise, and navigating it requires the same seriousness and preparation that you brought to your career. You worked too hard and saved too long to hand thousands of dollars back to the government because of rules you did not know about. So stay informed, ask questions, review your tax situation before the end of every year, not just during filing season. Sit down with a qualified CPA or financial planner who specializes in retirement taxation. And come back here because this channel exists for one reason: to make sure that the information that was always publicly available but rarely clearly explained is right here, in plain language when you need it. If this video opened your eyes to something you did not know before, leave a comment below. Tell us what surprised you the most. Ask your questions. We read every single one. If you found this valuable, please share it with a friend, a parent, a spouse, anyone approaching retirement who deserves to keep more of their own money. And subscribe because we cover Social Security, retirement taxes, Medicare, and financial planning every week, because your financial security in retirement matters, and you deserve to understand every dollar of it. Thank you for watching.